Hello guys, today we are going to start with the accounts. Account is mainly divided into four different parts. Part 1 consists of accounting, that is basics, fundamental of accounting, basic we'll look into this. You have already studied this in 11th and 12th. Then second part is for preparation of financial statements. That also you have studied like preparing balance sheets and all these things. Self-balancing ledgers, royalties, hire purchase, installment system, branch and department accounting. It comes in part 3, and the part 4 is computerized system, accounting in computerized environment and accounting standards. First three part will look into detail, but part 4, that is accounting in computerized system, it will be in summarized form. They have given the mark structure. Accounting, basic accounting will cover 25%, then financial statements will cover 40%, self-balancing ledger, royalties, hire purchase, installment system, branch and department accounts will cover 20%, and accounting in computerized environment will cover 15%. Okay, so our first focus will be on this financial statements and basics. You have already seen, we just have to brush up. And financial statements, somewhat scenario, you have done the balance sheets, trial balance, all these things. So our first focus will be into these things, then third, and then fourth. Okay, so we can easily score 60 to 70 marks in this subject. Okay, so we'll start with the first chapter, that is our fundamental of accounting. This the basic of the accounting, how accounting is done, why accounting is done, who does the accounting, what documents you require, and all these things. You have already seen this in 11th foundation. This is the same thing, we are just going to revise the things. Okay, so we'll start with the definitions of different things. So there are four basic definitions. This accounting is divided into four different parts: bookkeeping, financial accounting, cost accounting, and management accounting. Okay, so what is bookkeeping, what is financial accounting, cost accounting, and management accounting? It may Most of the time this bookkeeping and financial accounting are used interchangeably, but this is two different things. Bookkeeping is different and financial accounting is different. So in case of bookkeeping, the common definition is given by the J.R. Bartley boy. He says bookkeeping is an art of recording business transactions in a set of books. So you record transactions, what we do in trial balance, like recording journal entries and all these things. So J.R. Bartley boy says is bookkeeping is an art of recording transactions in a set of books. Set of books is a ledger, and recording transaction means passing journal entries. Okay, so what it says, as can be seen, it is basically a record keeping function. One must understand that not all dealings are recorded. Like only monetary transactions are recorded, whichever affects your financial statements. So not all records are recorded in the bookkeeping. Like, so some employees join the organization, some employees leave the organization, that entries are not recorded in, that is not covered into bookkeeping. Only transactions expressed in terms of money will find place in books of accounts. These are the transactions which will ultimately result in transfer of economic value from one person to another. Bookkeeping is a continuous activity, so it is not for some particular time period, but is done on daily basis. The records being maintained as the transactions are entered into the, this being a routine and repetitive work in today's world, it is taken over by the computerized system. Like bookkeeping, if you say single entry, double entry, all these things happen in manual books, but now we are not maintaining manual books. Everybody has the computer record. There are many softwares like Tally, SAP, Zoho, like many softwares which people use for their accounting work. Okay, that will be covered in last sections, computerized environment. Then bookkeeping is also recorded as a primary records. These records form the basis of accounting. It is an art because the record is kept in such a manner that it will facilitate further processing and reporting of financial information, which will be useful to all stakeholders of the business, like your shareholders, creditors, bankers, government, all this. They will use this record, financial information. Then what is financial accounting? Financial accounting, the definition of financial account is given by the American Institute, CPA, Certified Public Accountants. It's generally called a CPA. Like we have chartered accountants in India, they have certified public accountants in US. They give the definition as in accounting is an art of recording, classifying, and summarizing in a significant manner and terms of money, transaction, and events which are in part of at least of a financial character and interpreting the results thereof. So they have just give the extended version of what Bartley Boy gave. He also started with the it is art of recording transaction. CP also started with the art of recording transaction, but they extended as classifying, summarizing in a significant manner and in terms of money, transactions, and events which are part at least of a financial character and interpreting the results thereof. Like getting how your balance sheet is strong or not, it is loss making or profit making. So you interpret it. So what they're saying is first step in cycle of accounting is to identify transaction that all that will find place in books of accounts. So later on in coming pages, we'll see how what is the transaction cycle. What is the cycle that is used for accounting purpose? So first you have to identify transaction that will find place in books of accounts. Transaction having financial impact only are to be recorded. So in bookkeeping also only transactions which have some financial impact will be recorded. In financial accounting also only financial transactions will be recorded. So example they have given, a businessman negotiates with a customer regarding supply of products. This will not be recorded. Like only bargaining is going on. When it will be recorded? When there is some actual purchase or sale. The negotiation is a deal which will potentially create a transaction and will have an exchange of money and money's worth. But unless this transaction is finally entered into, it will not be recorded in the books of account. So only discussion part will not be recorded. Obviously it cannot be recorded what you will debit and what you will credit. So discussion part what won't be recorded. What will be recorded is actual deal, actual transaction like purchase, sales, expenses, etc. Secondly, the recording of business transaction is done based on a golden rules of accounting. You have already seen the golden rules. 3 golden rules are there. We'll see later on. Okay, so it is done on the basis of golden rules of accounting. Okay. So in transaction of similar nature are grouped together and recorded accordingly, like sales transaction, purchase transaction, cash transaction. So we have to interpret the transaction and then apply the relevant golden rule. In 11th, we have already seen what are golden rules, how it is implemented. In the coming chapter, in the same chapter, we'll look at the golden rules, how those are applied. And the thirdly, they have said, as a transaction increases in number, it will be difficult to understand the combined effect of the same by referring to individual record. Hence, the art of accounting also involves the steps of summarizing them. Generally, we say this a ledger. Like first you record journal entries, then we just look at the ledger. What is ledger balance? What is the total balance? Like we look into the trial balance and not the individual general entries. So they are saying summarizing them with the aid of computers. This task is simplified in today's accounting world. Like if you see the manual books, first you record journal entry, then you post those journal entries to respective their ledgers, then you make trial balance, then you make balance sheet. But in current system, computer system world, you just have to record journal entry. Ledger posting will be done automatically, trial balance will be done automatically, balance sheet will be done automatically. So you don't have to do everything. This task is simplified in today's accounting world. The summarization will help users of business information to understand and interpret business results. Lastly, what they're saying is accounting process provides the users with statements which will describe what has happened to the business. The statement is generally called many statement, cash flow statement, funds flow statement, balance sheet is also statement, profit and loss account statement. So remember two basic questions we talked about. One, to know whether business has made profit or loss. PNL, from PNL we get the information, and the other to know the position of resources that are used by the business. In balance sheet, the assets and liabilities. So assets and liabilities are nothing but your resources. Okay. Also, you have cash flow statement, funds flow statement. There are various statements which businesses make. Okay. So this was about financial accounting. Then we'll see cost accounting. What is cost accounting? In cost accounting, generally we record only cost. Financial accounting covers everything, whether it affects your production cost or not, it will be recorded everything. But in cost account, with what is our main focus is on the cost of production. What is my actual cost for this particular product? So our institute looks into this. Instead of management accounting, management accounts, cost accountancy is defined as application of costing and cost accounting principles, methods, and techniques to the science, art, and practice of cost control and ascertainment of profitability, as well as presentation of information for the purpose of the managerial decision making. What is important is managerial decision making. So what definition our institutes gave is application of costing and cost accounting principles. Okay, so there are many principles which govern this. So how it will be recorded, then principles, methods, techniques to the science, art, and practice of cost control and ascertainment of profitability, as well as the presentation of information for the purpose of managerial decision making. Okay, so what you will follow is normal accounting principles, methods, and techniques which are generally followed to the science, art, and practice of cost control. So obviously, everybody will try to minimize their cost. So they say you practice the cost control and ascertain whether there is profit or loss by presentation of information to the management. Why? For some decision making, whether you want to increase the production of this particular product, or you want to discontinue the product, or you want to change some selling price, increase, decrease, or anything. Okay, so it is a branch of accounting dealing with the classification, recording, allocation, summarization, and reporting of current and prospective cost and analyzing their behaviors. So who does the cost accounting? Everybody look at the cost, but generally big companies does the actual cost accounting. Like small proprietary trading firm, he won't be doing accounting for the costing. He'll calculate what is the cost of the particular product. If he's selling some a product, what is the total cost, like buying cost, then transportation, his storage cost, interest cost, everything he will calculate, but he won't do any accounting for that. Okay, why? Because his work is small, his turnover is small, and also there is no statutory requirement to do some cost accounting. But big companies, like let's say 500 crore turnover, 1000 crore turnover, they will be doing cost accounting because there is statutory requirement also, and they'll need actual information to take some decision, like for expansion, for reduced production, continue, discontinue of the products, new entry of the product, everything. Okay, so these accountings deal with the classification, recording, and allocation of summarization and reporting of current and prospective cost and analyzing their behaviors. Cost accounting is frequently used to facilitate internal decision making and provides tools with which management can appraise performance and control cost of doing business. So main purpose, most important purpose of the cost accounting is to facilitate internal decision making of the management. Secondary use is there is statutory requirement for the government. You have to do cost accounting. You have to record cost. What is the cost involved for particular production? So there are many sectors where there is statutory requirement for cost accounting. Okay, so it primarily involves relating to the cost to the different products produced and sold or services rendered by the services businesses, while financial accounting deal with the business transaction at a broader level. Cost accounting aims at a further breaking it up to the last possible level to the identify cost with products and services. What is the main difference in cost accounting and financial accounting? Let's say you purchase 10 different items, you are producing 10 different items. In accounting, in financial accounting, it will be recorded only as a purchase. That's it. But in cost accounting, they'll record purchase for X item, purchase for Y item, where it is used, why it is used, how much it is used, whether there is loss, abnormal loss, normal loss, everything will be recorded in cost accounting. But in financial accounting, it will be only recorded as a purchase. That's it. Same with the cases of salary. Salary will record salary. We won't bifurcate whether it is admin, for marketing, for finance department, nothing. We'll just record salary in financial accounting. But in cost accounting, we'll bifurcate for which department how much salary, for production how much, for marketing how much, for admin how much, for finance how much. So we'll bifurcate everything in cost accounting, but in financial accounting it will be recorded in total summary format. Okay. Then it uses the same financial accounting documents and records. Obviously, there won't be different record. There will be same records. Modern computer system accounting package like ERP system. ERP is kind of system. There are many softwares which are run as a ERP. ERP stands for Enterprise Resource Planning. Okay, ERP systems like Tally is ERP, SAP is ERP, Zoho is ERP, QuickBooks is ERP. There are many ERP softwares in the market. So ERP systems provide for the financial processing of financial as well as cost accounting reports simultaneously. If we just go by the theory, there should be two set of accounts. Like for financial accounting, there is different set of books. For cost accounting, there are different set of books. But when you go into computerized system, there will be only single system. But in single system, they'll provide you report for financial report, cost accounting report. Okay, so in computer, it is very easy to maintain all these things. Okay, so this branch of account deals with the process of ascertainment of the cost. The concept of cost is always applied with the reference to a context. Knowledge of the cost concept and their application provides a very sound platform for decision making. So it is mainly used for decision making for the management. Cost accounting aims at equipment management with the information that can be used for control on business activities. Okay, clear so far? Then last definition comes as management accounting. What is management accounting? Now, many times we get confused between cost accounting and management accounting. Why? Because cost accounting helps decision making for management. Management accounting also many times helps for decision making of the management. We'll see into theory, then we'll look into the what are the differences between them. So management accounting is concerned with the use of financial and cost accounting information to managers with the organization to provide them with the basis in making information business decision that would allow them to better equipment in their management and control functions. Starting what they're saying, it is concerned with the use of financial and cost accounting. So who will come first? First come will financial, then cost accounting simultaneously. But for management accounting, you'll need financial as well as cost accounting information. It will help managers to take decisions. What they're saying, unlike financial accounting information, management accounting information used within an organization. So financial accounting information is available to everybody, public at large. It will be shared with the it will be shared with the management, then your shareholders, creditors, your bankers, financier, government, everybody. It will be shared with the everybody. But cost accounting and management accounting will won't be shared with anybody. It is only for internal purpose. It won't be shared because it is classified. It is secret information. So it won't be shared with anybody. And it's usually confidential and its access available only to the selected members. Obviously, you cannot give this access to your labors. It will be always accessible to the higher authorities, higher like supervisor, manager, senior manager, CEO, CFO, MD, board. That will be access to only those senior persons. According to the Chartered Institute of Management Accounting, like our institute, management accounting is the process of identification, measurement, accumulation, analysis, preparation, interpretation, and communication of information used by management to plan. So you measure, you accumulate data, you analyze the data, you prepare, you interpret, and you communicate this data to the management. Why? They use to plan, evaluate, and control within an entity to assure appropriate use of and accountability of these resources. So what we say is optimum utilization of the resources. To get optimum use of the resources, you need all this data. From financial accounting you won't get optimum utilization, but from cost and management accounting you'll know whether you are using resources in best manner or not. Management accounting also comprises the preparation of financial reports for non-management groups such as shareholders, creditors, वगैरह. Okay, so this information is also used for preparing your final balance sheets. Basically, management accounting aims to facilitate management in formulating strategies, planning, and constructing business activities, making decisions, optimal use of resources, and safeguarding the assets of business. So, where it will help? First, to formulate strategy. What is business strategy? Like they are finding some new market. So, this is strategy. They are thinking on acquisition of the new company. They're thinking of demerger, merger. So this is strategy. Planning and constructing business activities, how it will be sold, where it will be manufactured, what price, everything. Making decisions. entry into new market, then the R&D of new product, all this. Optimal use of resources. What is optimal use? Means the best use, the maximum use you can get from the resources. And safeguarding of assets of business. So safeguarding of assets, like there will be security and many things. Okay, safeguarding of assets of the businesses. Then we'll see difference between bookkeeping and accountancy. These words many times used interchangeable, but these are two different things. So what is bookkeeping? Bookkeeping is considered as end of a transaction. Accountancy is recorded considered as a beginning. Like from accounting, you make various statements, you make balance sheet, but from bookkeeping, you don't make any balance sheets. The function, what is the function of bookkeeping? The primary stage of accounting function is called bookkeeping. Primary stage of accounting means recording journal entries. Accountancy is the overall accounting functions are guided by accountancy. Overall functions means how a record should be recorded, how a transaction should be recorded, how it will be posted to the ledger, how statements will be made, how balance sheet will be made, how P&L will be made. So it is guided by the accountancy. Bookkeeping can provide base for accounting, like journal entries. Accountancy depends on bookkeeping. Why? Because unless you record the journal entry, you cannot do anything. You cannot prepare any statement, you cannot make balance sheet. So bookkeeping is the base for everything. The necessary data about financial performance and financial positions are taken from the bookkeeping. Accountancy can take its decisions, prepare reports and statements from the data taken from the bookkeeping. Again, bookkeeping is the basis for every data. Why? Okay, you'll get sale purchase data from your accounting record, from trial balance, P&L, but for making that you need bookkeeping. So again, bookkeeping is basic for everything. Financial transactions are recorded on the basis of accounting principles, concepts and conventions. There are old principles going on through many years, many decades. We follow the same principles. Like if you ask why the particular expenses should be debited, why we cannot credit it, why we cannot change the golden rule. So it is continuing since ages. So we follow the accounting principles. Accountancy does not take any principles, concepts and conventions from the bookkeeping. Like you have recorded basic entry through golden rule. Now if you have recorded the basic entry, you have to post it debit or credit, but you can make your own statements whenever you like. You take provision for bad and doubtful debts. If you take provision for bad and doubtful debts, provision should be shown on the liability side. But for our better understanding purpose, many time provision for bad and doubtful debts is reduced, deducted from the debtors. So you can have your own principles as per the practicality. Okay, but in bookkeeping you cannot. You have to follow the golden rules. Now difference between management accounting and financial accounting. Management accounting is primarily based on the data available from financial accounting. So management accounting is dependent on the financial accounting. Financial accounting is done on the basis of monetary transaction, whatever transaction you do, which have the some money involved. Then management accounting provides necessary information to the management to assist them in process of planning, controlling, performance evaluation, and decision making. But financial account cannot. Its main function is on recording and classifying monetary transaction in the books of accounts and preparation of financial statements at the end of every accounting period. It's just to complete the accounting, prepare trial balance, from that prepare balance sheet, P&L. That's it. But management cannot use financial accounting for their decision making purpose. Then reports prepared in management accounting are meant for management and as per the management required. So like whatever report you management asks for, we make customized reports. So there is no standard format. Like in financial accounting, balance sheet has a standard format which has given by the Companies Act or some other statutes. But in management accounting, there is no standard format. It will be customizable only. Okay, reports as per the financial accounting are meant for the management as well as the stakeholders and creditors of the concern. So financial accounting is meant for everybody. Management will use, creditors will use, shareholders will use, government will use, everybody will use that financial accounting records. And reports may contain both subjective and objective figures. Management accounting, subjective and objective means what are the actual transaction, what is our goal, budgets, everything. But financial account is always supported by the relevant figures, and it emphasizes on objectivity of the data. So mainly in financial accounting, it will be historical data. There won't be any budgeted kind of data in financial, but management accounting, there will be budgeted data. In management accounting, reports are not subject to statutory audit, obviously, because it is for internal purpose. But financial accounting, you have to do statutory audit under many cases, under many different acts. You have to do audit. Like if we say company, you have to do statutory audit under Companies Act. If you say it is income tax, you have to do audit under Income Tax Act. Like GST, GST Act, Excise Duty Act. Okay, then management accounting evaluates the selection as well as entire performance of the business. So it's sectional, like department wise also it evaluates an entire performance, like whole. Let's say you have 4 departments, it will have 4 departments performance, who is performing good, who is performing not good, and entire as a whole, like summary form. But financial account, it ascertains, evaluates and exhibits the financial strength of the whole business. There won't be any data for particular department. It will be total sale, total purchase for whole 4 department, total expenses, total incomes. So in detailed form you can have in management accounting, but financial accounting will be always on summary for whole business. This was difference between the bookkeeping accountancy and management financial accounting. Okay, clear so far? So now we'll look into what is accounting cycle, what it is started. First, it starts with the recording of transaction. Before that, there will be some transaction, actual transaction will happen where there is some monetary terms like sale, purchase, expenses, salary paid, salary received, everything. So first, recording of transaction, it will be recorded in journal. So you'll have a journal there. Then this journal entry will be posted in their respective ledger. Let's say there is a credit sale. So entry will be, first there will be sell invoice. You'll record this transaction. This transaction entry will be like debtors account debit to sales. This will be your journal. Then this entry will be posted. How it will be posted? Debtor account will be debited and sales account will be credited. On this, you'll make trial balance. Trial balance will have a summary format. Sale for the year, debtors for the year. There won't be any individual ledgers, only debtors. Okay, if you go in detail, you'll get the list of debtors. But in summarized trial balance, there will be only sale and there will be only debtors. Then you'll make some adjustment entries, like we discussed provision for bad and doubtful debt. This will be adjustment entry. If there is some wrong entries are recorded, you'll make adjustment of that. Then you'll have adjusted trial balance. Then there will be closing entries. Closing entry means like you have different ledgers here, but differently. Let's say for expenses you have 100 ledgers, but those 100 ledgers should be summarized. Then you won't be any expenses ledger in your balance sheet panel. There will be only profit and loss account. So you have to transfer all your expenses and income ledgers in your P&L account. So you pass sale account debit to P&L, so that sales will be created in the profit and loss account. That will be recorded in profit and loss account. Okay, so like this, all the entries, all the ledgers will be moved to the P&L account, but not in case of assets and liabilities. Assets and liabilities will be stand as it is. It will be just shown in the balance sheet. On this basis, you'll make a financial statement. Financial statement generally consists of balance sheet, profit and loss account, all schedules, annexures to the balance sheet, P&L account, then your cash flow and fund flow statement. Okay, so this will end your accounting cycle. So this is the accounting cycle. From a deal, it starts here and ends to the balance sheet. I hope this is clear. Okay, so the next part will continue in the next lecture. Thank you. Good day.